What's up, guys? Today, I'm going to be sharing with you my Robinhood portfolio. I'm just going to show you all my holdings, all my stocks, and the growth that I've had since I started it. Just this year, I started this year, and I'm also going to explain some of the investment principles that I'm using to pick these stocks and to buy these stocks. And just to be clear, let me go ahead and share my screen so we can just get into it. I'm not doing this so that you can copy my picks, because stick around throughout the video and I'll share with you exactly why. Because you might try to copy my picks that you see in here and then end up losing. Because stick around and I'll share why. All right. So this is my investing account in Robinhood, but let's start off by looking at retirement, because I fill up my Roth IRA first. Once my Roth IRA has had its maximum contribution, which is $7,000 in a year. That's the most you can contribute in a calendar year. Unless you're in your 50s, then you can do 8,000, I believe. But I'm not in my 50s, so the most I can contribute to my Roth IRA is 7,000. And so once I've contributed that full $7,000, then I start putting money in my regular money market account. We'll get to that in a second. And so as you can see, I contributed $7,000 in here, but there's a total of 7,902. Because that's the gains that I've gotten in here so far. So this is the results for today. We've had 0.5% drop, but let's look at just since I've started this thing, right? And then we'll get into the individual picks. So the last week gained 1%, so $105. The last month, okay, 3.9%. That's $296. The last 3 months, see right here, you can see this is where I started the Roth IRA. Right. So it's gained 12.89% over the last 3 months. Now, something that I always like to do is 12% sounds really good, right? But what if the S&P 500 did 20% over the last 3 months? Well, that means that 12% wouldn't be that good, right? I could have just put that money in an index fund and left it alone and it would have did better. So what I always like to do is I like to, instead of just looking at the percentage and deciding if that's good or not, I'll look at the S&P 500 over the same time frame and compare. So let's go over to VOO, because I have some stock in that. That's Vanguard's S&P 500 ETF. Look at the last 3 months. Okay, S&P 500 is up 5% over the last 3 months. And my IRA is up pretty much 13. So that's good. More than double the market, right? Over the same time frame. So what am I doing in here, right? Let's look at the stocks that I have in here, and let's display this by, see, we already have it as total return. So you can see right here, actually, let's display it like, there we go. So the best return down to the worst return. That's how this is listed. So CoreWeave, 92%. I only have a fifth of a share here. Honestly, something that I've realized, this was an IPO and I just bought it just to see what happens. That's something that I'm no longer willing to do in my IRA, because I did that with another IPO that you'll see in here that is losing money. And the thing is, you only get $7,000 per year to put into your IRA. So the last thing I want to do is take like $1,000 of that $7,000 and put it into an IPO or some risky stock that tanks, because I just made it so that my yearly contribution for that year is now $6,000 instead of $7,000, because I lost. Because if you lose money in your Roth, like, that sucks. And Roths are really good because it's tax advantaged. And what I mean by that is, all IRAs are tax advantaged, but specifically Roth IRAs. You take your money after you've already gotten paid, after it's already been taxed, and you put it in here. And so because of that, as it grows throughout the years, decades, when you pull it out, you pay zero tax on it. So your money gets to compound and compound and compound. Let's say you get, over the course of your life, you get your Roth IRA up to $1 million, $2 million. When you go to withdraw that money after you're 59 and a half years old, you don't have any penalties. Well, you just pull out that whole $2 million, no tax, boom, straight to your bank account. That's why You don't want to lose any of the dollars that you can put in here because they're really valuable. So anyways, CoreWeave, this is the first stock that has a high return because it was an IPO bet that worked out. And honestly, it wasn't even that much money. You can see my 92% return was only $15. And I had more of it, but I sold it because it was doing well and I didn't want it to go down to zero in the future because it's not a proven company. It doesn't follow my framework. So as we're going through these stocks, let me just share the framework for you really quickly. And this is how I like to look at things now after making some mistakes. And we'll go over some mistakes. And so here's my philosophy. I'm like, ooh, this looks like a good stock. Maybe I want to buy it. I think this to myself. Will this stock be worth it? Let's say that I buy this stock and I don't ever plan on selling it, ever. The only thing that I want to do with this stock is hold it until after I die and then give it to my kids. And if that's my game plan in my head, that means that this has to be a long-term play. It can't be like, I'm going to buy the stock and wait for it to shoot up because I think the market's going to do this or think it's going to do that, and then I'm going to sell it. No, this means like, okay, am I willing to go through that process with this stock? If the answer is yes, then I buy it. If the answer is no, or even better, I don't know, if the answer is either of those things, not buying the stock. So that's why I sold some of my CoreWeave. Robinhood, I think that's definitely a yes. As you can see, I'm using it right now. Like, quick story. When I started these accounts, I connected, what was it at first? Fidelity. Created an account with Fidelity and had all these tech issues trying to connect my bank account to it, and it wouldn't connect it. And I was sitting there for 2 days trying to connect my bank account. And this is as the stocks were like plummeting because of Trump's tariff announcements. And I was like, I'm trying to get this thing working so I can put some money in the market while everything's cheap. And then eventually I was like, I'm just downloading Robinhood. I downloaded it, connected my bank account. Like, after I created my account, it took me 5 minutes to connect my bank account. And then I had money in the market. I was like, this is way better. Anyways, that's just my personal opinion. If you want to check out Robinhood for yourself, there's a link down below this video. That I think if you use it, connect your bank account, you get some free stocks, I get some free stocks, everybody wins. But that's neither here nor there. I have stock in the company. I believe in it. I like what they're doing. And I've also researched it. I've researched the trend of retail investing. And so it's looking good. NVIDIA. I made a recent video about NVIDIA and the AI boom. That's we feel like we're in it, but it's actually coming. If you want to check that video out, it's up in one of the corners. But yeah, so I would hold on to this forever. Reddit. Really interesting with Reddit. And as you can see, I barely have any shares. I've noticed this trend where it's like there's ads on Reddit. So of course they're making money. But whenever I want to find out some information, like how to solve a problem, when I go into Google, I don't just say like, hey, how do I do this? Because I know I get a bunch of blogs and a bunch of things that are trying to sell me some crap. So I just put Reddit at the end of every question. I did it before this video. How to connect my iPhone to my MacBook so I can use my iPhone as the camera. Reddit. Because I want to see other people's real answers. And that forces me onto the platform. And so their stock is doing great. I'm just going to hold on to that. All these ones at the top that I have good returns on are all stocks that I just want to hold on to anyways. Meta, their AI, like I want to hold on to that. Microsoft, same thing, AI. Spotify, interestingly enough, seems like a really good company. Who listens to music anywhere else? There you go, right? And they keep charging more for their services, and they have a bunch of other things that they do they're charging even premium users for audiobooks. You can only listen to a certain amount of audiobooks per month, or you pay more, and you could listen to unlimited. So their monetization is on point. Market penetration is pretty deep. So this is a fund, SPMO. All the funds I want to keep in here because they're just averages. SCHG, that's also a fund. IVV, that's a fund. And by fund, I mean ETF, exchange traded fund. Netflix. Netflix is a monster stock, and their price is like $1,200 or something like that right now. They're not doing a stock split because they have a lot of institutional investors. They don't need they don't need to split the stock to make the price go down so retailers can buy it. Luckily on Robinhood, you can trade fractional shares. So I don't have to buy a whole share. I can buy, what is this? 8/100ths of a share. BlackRock's not going down to zero. If they do, the whole economy is in trouble. You're going to lose a lot more than your investment if BlackRock goes out of business. They own just a ton of physical assets and other assets. VU, of course, is the S&P 500. VWO, that's another ETF. HQ, another ETF. Amazon, everybody knows what Amazon is. VEA, ETF, this is an ETF. MBIS, ETF. Google's kind of a sleeper right now because I don't think people are really putting together that like Waymo is the Tesla's competition for self-driving cars and robotaxis is owned by Google. So when you're buying shares in Google, you're actually buying shares in that too. And that hasn't even reached like full monetization or scale yet. And so, so I'm going to go through these stocks just to tell you what they all are, because I said that I would. You can see how much I've made and the percentage next to each one of them. But then I'm going to share with you my framework and why you shouldn't just go buy these right now because you see them on here. This is another fund. This is another Google share because they had a stock split a while ago. Bond, this is an ETF that tracks the bond market. Costco, Coca-Cola, another really good company. I'll let you know when I get to a company that I wish wasn't in here. BGSH. Come on, where's the rest of them? I got a lot of them. Maybe I got to refresh this. Yeah, my internet is doing weird things. Are we still recording? Yes. All right. Now, it'll return. Cool. There we go. Let's go from worst down to the top. Arrow, this is an IPO that I invested in. About 4 shares at $30 a piece. And as you can see, I've lost 30% on the investment. And I'm like, now I'm just hoping it goes back up to zero or more so I can sell it, because when I sell it, that money goes back into my Roth IRA and I can put it towards those companies that I would be willing to hold on to for the rest of my life. Like I said, I made that rule after investing in this and saying, damn, that was a mistake. This was a mistake because I didn't even look at their balance sheets. I was just like, everyone knows McDonald's, and I didn't do my due diligence. Lucid, this is a bet. Like, this is dumb. Like, I'm not saying you shouldn't buy it, but do your research. I did not. I was like, oh yeah, electronic vehicles, big thing. 55 shares. It's so cheap right now. And it's just gone down. It's just gone down 4%. I've only lost $4 on it, but Warren Buffett's rule for investing. Rule number 1, don't lose money. Rule number 2, don't forget about rule number 1. So, yeah. Rivian, this is another one. It's another electronic EV play. I just see them all over the road out here in California, and I bought their stock. No due diligence. Stupid. As you can see, all the ones that I'm like, these were dumb. They're all losers, right? They're all losing right now. But I don't want to sell it and cut my losses because I'm waiting for the stock just to spike up because the market does really well. And then it kind of rides these stocks along with it and hope I can get back to positive before I let them go. Colgate, same story. ConocoPhillips, that's COP, same story. Berkshire Hathaway, I will hold on to this forever. It's just negative right now. I follow Warren Buffett's investment principles. Like, of course, I'm going to invest in his company. It's just down right now compared to when I bought some shares. Tesla, definitely holding on to this just because they're a robotaxi and robotics company. And that's going to be huge, I believe. UBSI is a banking company. You don't know much about it. Waiting for it to get positive, then I can sell it. Procter & Gamble, same. I mean, we all know what they do, but I'm trying to invest more in the future in companies that I think are going to be around. So I don't really need to hold on to that. Pepsi, I bought it just because of the dividends. A lot of these companies that I'm like, I don't really know much about, I bought it just because of the dividends and I regret it now. Yeah, I get some dividends from Pepsi, but I'd rather have growth. So waiting for that to get positive again, then I'll let it go. Same with Verizon, same with BCE, Canadian telephone company. Annually Capital, I don't know much about it. MSTR, MicroStrategy, think they make like chips or something. I don't really know. See, this is the problem, right? Home Depot, it's traditionally been a really good stock, but I don't think I'm going to hold on to it. Intuit TurboTax, holding on to that. I only have a tiny bit of it, but I'll be adding this. I'll be continually adding to the portfolio here. Same with Waste Management. Waste Management has been solid for decades. Merck, they're in the healthcare industry. I'm going to let it go because I don't know much about it. I've heard people say it's a good stock, but that's about it. SCHD, of course, this is an ETF based off of dividends. We have Apple. I'm definitely holding on to that. This is another ETF. Then we have Coca-Cola. So we're back to the stocks that we already looked at. So let's talk about, I already shared with you how I pick a company that I want to invest in. But how do I know when it's the right time to put my money into those companies? Well, the beautiful thing is, if they're companies that I feel like are going to do well beyond the span of my life, I can put money in every month. It doesn't matter what the market's doing. But I'm the kind of guy who likes to look at the market, see what it's doing, and capitalize on downtrends. So let's say that I have $1,000 a month that I can put into an IRA or into my investment portfolio. Well, when it looks like the market is doing well, like it's up, not like today. Obviously today it's like, it's gone down a little bit. I mean, my investments have at least. But when I look at like the S&P 500 or individual stocks that I'm interested in, if they're up, if they're in the green, they're positive, especially looking at like over the last year, right? Let's look at Reddit over the last year, just for an example. See, Reddit spiked up here. Wait, hold on. Last year, that was today. So this was the high over the last calendar year. And so right now it's lower than that. I mean, I would buy it right now. If I see a significant dip, like if I'm noticing that I'm somewhere down here, and this is in these good companies, by the way, I'm going to buy more. I'll put that whole $1,000 into it if I have that much to put into Reddit. If I see that it looks like we're on an uptrend, I still want to put money in because time in the market is better than timing the market. And so I just wouldn't put as much. I would put maybe I would split it in half and put 500 and leave the other 500 aside in a money market account where it's growing at 4%, so that when I do see it dip, I can deploy it into there. That's it. And that's why I say don't just copy these trades, these investments, because let's check this out. I'll show you exactly why. Let's look at NVIDIA today. Okay, NVIDIA's up for today. It's like, oh, it's up for the week. Oh, it's up for the month. Oh, it's up for the last 3 months. For the entire year. Oh, okay. For the last 5 years. Oh, max. As long as it's the most expensive that it's ever been ever right now. Now, I do think they're here to stay for decades and decades and decades, and that it's going to continue to grow. But if all I have is $1,000 for the whole month to put into one stock, I wouldn't put it all in NVIDIA today. I would split it. I would say, okay, let's take $200-$300 and put it into NVIDIA today. And let's just keep checking the stock day by day, week by week, because usually what happens is once a stock starts rising, some people start taking profits and they start selling because they want to make sure that they get some profit. When that happens, the market, the price of that stock will go down a little bit because some people are selling. Institutional investors, retail investors, they'll be selling. And then when they do, then you can spend more of that $1,000 to buy more of that stock at a cheaper price. It allows you to purchase more of the asset with the same amount of cash. So would I buy this today? No, I didn't. I have shares and I'm not buying it today. Anyway, so that's my IRA. That's my philosophy for investing. If we go over to my investment account, you'll see the same thing. This is, I put this in here after my IRA was capped. And yeah, so that's why it's like this is less than a month old, because I capped out my IRA. Then I started putting stuff in here. And as you can see, this is only got at 5%. And that's because of the timing. Last month when I started, or 3 months ago when I started my IRA, that was right after Trump had announced the tariffs. So everything was dirt cheap. The S&P 500 dropped like 10%, along with a lot of other companies. And I plowed money into these assets at that time. So I have a bigger return now than I do here. But let's compare this to the S&P 500, right? Because that's how you know if you're doing good. So over the last month, this has gone up 5%. And then if we look at the S&P 500, over the last month, gone up 3%. So I'm still beating the market there, which is good. And these aren't huge grand slam, knock it out of the park gains, right? What these are the kind of gains that aren't sexy, that don't like impress people after 1 year. Like you might have somebody that's taking a lot of really risky bets, and then one of them pays off and they get like 100% return. Like if I dumped all this money into CoreWeave, right? In hindsight, it's like that would have been great because I would have taken my $10,000 portfolio and turned it into $20,000 over a period of 2.5 months, right? But what if I dumped it all into AIRO, which has lost 25-30% since it IPO'd 2 weeks ago? So the people who get the grand slams, they also get a lot of losing bets, and that's what I don't want to do. It's up to you how you want to invest, though. See you in the next one.